Are investors too complacent? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Ben Miller, co-founder and CEO of Fundrise. Hi, Ben. Welcome.
Yeah, thanks for having me.
This is your first time on Real Vision. We're thrilled to have you on. So why don't you, before we jump into today's action, just give us a little overview of Fundrise. What do you concentrate on there?
So we're a real estate and technology investment platform. We started in 2012. Basically, I have about 25 years of investment experience. I bought about $10 billion of real estate in my career. So have some experience in this. And I basically felt like the 2008 financial crisis had undermined my confidence in the financial system. And so we created a new model where individuals could invest directly into real estate or private technology companies and not have to have a lot of the kind of like noise you see or fees in the traditional financial system. So I guess it's kind of a similar ethos as crypto, but instead of investing in like a digital asset, you're investing in a real asset.
Awesome. So it'll be really interesting to hear your thoughts given this environment. I feel like both of those topics, both technology and real estate, are really top of mind for a lot of people, given the fact that we're trying to figure out what's happening with the economy and interest rates. And it's been interesting today's action because we see stocks in rally mode again. Yesterday, things fell off, a little concerned about the BOJ. And that BOJ actually did something. They actually tweaked yield curve control. But this time around, everyone seems to be focused on, the data and numbers coming out. I mean, we have the NASDAQ up almost 2%. So I want to unpack a little bit of that. But just generally, it seems to be feeding into this, the numbers out this week, the earnings, the econ numbers seem to be feeding into this soft landing narrative. And we've been seeing this play out all week, and our guests have been sort of pointing it out and talking about it. So let's have a listen to some of the highlights, and then we'll talk on the other side.
Normally, we see Fed raising rates and fiscal policy getting tighter. And that's why you usually get a slowdown pretty soon after that. Whereas in this case, we haven't gotten that. We've had fiscal policy kind of offsetting monetary policy. And I think the fact that we've had the Infrastructure Act, the CHIPS Act, the Inflation Reduction Act, all coming after all the stimulus that came from COVID, has been given sort of a longer chain of fiscal stimulus that's kind of working its way through the system over time and affecting more the industrial side of the economy. People are building factories and doing new things they didn't do before because of fiscal policy. And so it's less about, tax cuts and things like that, or cash for clunkers or things like they did after the 2008, 2009. This is a much more broad-based and industrially focused kind of fiscal policy. And it's having knock-on effects in the private sector, I think, which has been kind of underestimated so far because it's just been so long since we've ever really seen that in this country.
I honestly think that the probability has risen for such a scenario over the course of the past two or 3 months here. And that is probably also why the Fed is starting to acknowledge this scenario to a larger extent and started to sound more upbeat on the actual possibility of creating a soft landing. It is not the standard scenario to expect given what we see in the yield curve right now, but you shouldn't rule it out.
From the perspective of the very leading indicators, the leading edge, the vanguard of inflation statistics, it's likely that we have gotten back to 2%. The reality is, however, if we don't go into a recession and the labor market continues to, remove, slack, by obviously hiring more and more people, and, that's the nature of this business cycle process, eventually those numbers that are, 1.4 or something, a little bit higher for PCE, those numbers are going to prove to be unsustainable. And we're going to start to tax the economy and really, drain slack and really tax the supply base of the economy again. And that could be a 2024 story if we do, in fact, have a soft landing. Now, again, I've been on record here. I don't think a soft landing is the highest probability outcome, but I do think it's a higher probability than a near-term recession.
I follow the year-to-date horse race, and where were energy stocks before I went on vacation and sort of the weeks prior to that? They were down 10%, 15%, sometimes 20%. Where are they now? They're bubbling back towards unchanged, and they're down 1 or 2% on the year. Does it seem like that sector could be up 10% on the year at a certain point if oil rallies just a little bit? Yeah, it sure can. There's nobody in it. We saw everybody take all of their money out of these stocks. So I feel like there are tumbleweeds blowing through this trade, And when I see that, I mean that's the time to get the weapons out and start firing.
So I just want to be clear on one thing on time frame, which our viewers will know we talk about all the time. Both Andreas and Darius are talking in the very near term, which is important from maybe their medium term outlook. But Ben, we did see that the more evidence of that today, right? This is why I think the probabilities for some people are going up, at least in the short term, for that soft landing. The PCE, that inflation reading that the Fed tracks closely, out this morning showed a modest monthly increase, and the annual level now the lowest in 2 years, still above the Fed target, but lowest in 2 years. And we had strong earnings, Procter and Gamble and Intel. So we keep getting all of this information that seems to be bolstering this idea that we're in this really sweet spot. How are you thinking about all of this?
So my perspective is different for two main reasons. So we have, millions of individual customers. Our Fundrise basically is a platform for individuals, and so I'm focused on people, not trading, not a lot of the things that you see essentially on Squawk Box.
Mhm.
And then also we invest into the real economy. So we have tens of thousands of residential units. We build housing. We invest in building companies, and so as a result, I'm mostly focused on two things, right? Protecting on the downside and on what it takes to build things in real life. And so it takes a long time to build things. And so as a result, I have a longer horizon. And I look out 2-3 years, and I look back 50 or 100 years. And it seemed really clear to me that this is a giant bear trap.
Why so?
Why? Okay, well, so uh, when I try to understand the future, I always look to the past. And if you look at the past, everything now seems different. It seems unusual or unique, but actually, it's most things are in history. You can go back thousands of years; they repeat over and over again. And so here we are, and the recession that's coming is almost at this point like destiny, because when the Fed raises rates the way they have had to in the last now 12 months, it almost always leads to a recession. And there's just basic reasons why. When you have cost of interest now for real estate, it is often 8, 9, 10%, and would have been 2, 3%, maybe 4% only 18 months ago. If you're a business, if you're a consumer, all of that higher cost is leading to a slowdown. But the slowdown takes a long time to work its way through the real economy, through a business. Like we have 300 people at the company. We have all these projects we invest across the country, and that delay, I think, is really confusing everybody because we live in a world of information technology where everything's instantaneous.
Mm.
But every single time, if you look back, this type of dynamic leads to a recession.
So that's an interesting point. We're a sort of immediate gratification society, and so, but things have felt compressed, right? So we have recently. It feels like that things got really bad really quickly, and then there was extraordinary measures, and then things got better really quickly, and so there's an expectation that you're going to see the impact more quickly. So you think this is tracking? How does this measure up? Is this tracking in a traditional manner in the way monetary policy takes a while to factor in? Is it taking longer because of some of what we went through with COVID and supply chains? Why does it seem like that we're not seeing the impact from monetary policy?
Yeah, so it's perception of a reality. So if you go back and look at the data, which I did, and you could even pull some of it up, Brian. Like I think slide 5 is the last 7 recessions. Yeah, that one. So basically, look at this. Every major recession, 2008 financial crisis, 2000, 89, 1980, all of them were preceded by major interest rate hiking. But those hiking always took a lag before it hit the economy. So you're talking about on average, a 10-month lag, 10 months from peak interest rates. So like go back to 2008, peak interest rates hit July 2006, and we didn't have the financial crisis for basically 24 more months, almost 2 years later.
Mm.
And so that's basically what happens every single time. So maybe we hit peak interest rates this Wednesday, or maybe we have another hike or two. And then from that point, you should expect a good number of months, on average 10 months, before you actually have a recession. So that would be late 2024, maybe early 2025. So you're still a ways off from actually having a recession. And then when a recession hits, they're so consequential that they make all this trading we're seeing day to day today look trivial. So if you go, I have another slide I want to show, but basically, this is what is in the data and is so clear. And I think I see it in the real life too. I can give you examples that we're seeing day to day, but the recession comes out of, it's a consequence of high interest rates, just like night follows day.
So what is the other what other chart do you want to show us? Because I think that will be
slide 3 I think is a good one, because I think it's like why am I so focused on this? Because everybody looking at it day to day, week to week. That one exactly. So here are 4 recessions. Each one of these had interest rate hikes, and when the stock market fell, it gave up most of the returns you'd previously seen for the last 5, 10, almost 15 years. Right? The 2008 financial crisis gave up 14 years of returns in the S&P 500 when it finally fell. Same thing with the year 2000, same thing with 1989, 1974. You basically, if you're a fundamental investor, not a day trader, this is not for day traders. They've gotten out, but most people are longer term fundamental investors. And so if you're pouring into the stock market shortly before one of these downturns, I mean, it's so consequential. It just makes any of the sort of hype you're seeing in the short term look like a bear trap.
Yeah. So and that makes a lot of sense. For our regular viewers, we've talked to Miss Schneider about the danger of those drawdowns, like how difficult it can be to come out of. So you make a really important distinction, I think, Ben, which is understanding your time horizon, right? So some people who are listening, and also some of the guests we've had on, do have to pay attention to short term. They are interested in the short term. And so what we've been hearing is that it's just so hard to fight the rally we've seen, and so hard to stand in the way of, in particular, the tech rally. Anybody who's tried to, well, people certainly on the sideline have missed it. Anybody who, heaven forbid, has tried to short it has had their face handed to them. So it's just been really powerful. How long do you think those go on? I mean, if it's a bear trap, can it, and the recession's not coming until late 24, that's a long time from now. Can it continue to grind higher, or does it start to backfill and sort of get rangy as people try to sniff out maybe something's wrong?
I think that's impossible to know. I mean, that's it's the path, the path to the final downturn is driven by so many short-term drivers. Like you might see more AI technology come out and drive more excitement. It's very emotional. It's not driven by a lot of the fundamentals, I believe, and it's because I'm in the real economy. We're building thousands of homes. We have industrial properties. We have companies we're funding. We're building our own company, and in those contexts, the decisions you're making, you have to be thinking about it in a multi-year, scenario. Right? Multi-year, am I going to build this factory? Multi-year, am I going to basically hire 100 people or not? And in that context, there's no way with this cost of interest that you do those types of investments now. And I'm seeing it day to day. We have, I'll give you an example. We have industrial property in Phoenix, and we had a tenant lined up, big e-commerce shoe company, huge. You would know who they are. They've been working on it with us for months. And the last minute, their board said, well, we better just slow down and stop and take a pause and just sort of wait and see what happens. And that kind of CapEx investment is a kind of CapEx investment that's basically slowly stopping, growth. Um, I'm out there. I've talked to all the major banks. We have billions of dollars of financing from basically every major bank you could name, and they're all frozen. I mean, you can't raise equity or debt for most projects today. The cost of digital marketing. Last year we spent tens of millions of dollars in digital marketing. We have an entire team of 25 people. All they do is buy Google ads and Facebook ads, and so we have a really good sense of what's happening in the economy because the advertising spend is a good reflection of real economy. And the cost of click, the cost of actually that advertising has fallen 50%.
Wow.
So there's just so many. So I don't know about the stock market. That's doesn't make any sense to me, and that's not what I do.
Mm-hmm.
But in the long run, this stuff is what matters.
Right. When you have that longer time horizon. So are you, one of our viewers is asking, is a cash position the best strategy moving forward? I'm going to tweak that because I think you're asking, neophyte from an investment point of view, but Ben, just from a purchasing point of view, from running a business point of view, are you very concerned about holding on to cash and having dry powder because of the recession you see coming?
I mean, so I have to do a little nuance, but yeah, I don't think there's anything wrong with 5% CD. 5% Treasury. It's hard to beat that, and I don't think that anybody who's having concerns would regret that kind of investment. And I think a lot of companies are sitting on a lot of cash who are also making similar calculus decisions. So that's when in doubt. I believe when in doubt, don't.
Mm-hmm.
And
Yeah.
I know that for parts of the economy, and this is where I have exceptions, parts of the economy like AI, there are sort of generational things happening, and we invest in those types of companies too. And so you'd say yes, that's true broadly, but with some exceptions, and maybe those exceptions are they're situational. You have to really know what you're talking about in the weeds of those decisions.
Right. Roger is saying timing looks so easy in charts, but it's really hard in real time. You are right, Roger. It is. And that's why we put that highlight clip of all the guests talking this week, because I think they're all touching on that. You have to be nimble, and even the best of them are going and looking against the frameworks they use and revising it. And that short-term part of it has become really tricky because you have this dynamic. If you're fixated on a longer term view, like you are, Ben, a little bit different. I want to ask about, so you see, so the fact that you're in commercial real estate, super interesting. You are definitely seeing signs of slowing in the real economy in terms of purchasing decisions. What's the state of the commercial real estate market right now? I mean, I don't know what part of it you're in, but we were so worried about that and the impact of higher rates hitting and the bank situation, the credit tightness because of what happened with regional banks. And it feels like that's kind of gone to the back burner. Where are we with commercial real estate, the state of commercial real estate?
Yeah, so I cover a lot, and luckily we don't invest in office. We never really had much exposure to office. You can say we were smart and lucky. I'll say we were lucky. So that's a really good illustration of like the destiny of something, and in the short term there's uncertainty. The office industry will go through a major downturn. There's no question about it. It's already happening behind the scenes. I don't know if it's 20% of office gets foreclosed or 50%, but it's something huge, just absolutely catastrophic. It'll cost hundreds of billions of dollars. And the negative of that is that there's a lot of equity wiped out. A lot of lenders are going to see huge impairments, and downtown cities are going to suffer. But the gift of it is that there will be a rebirth, and a lot of downtown offices will eventually end up much more vibrant, but it's going to take 10, 15 years. I mean, this is going back. This all happened before to downtown real estate in the 70s and 80s. and there was a huge downturn. And most of those downtowns really, I mean, there was crime and derelict buildings, and what it came out of that. New York had the art scene in Soho. People could live in Soho for $100 a month, and now it's $5,000, $10,000 a month. So this cycle, this is what I focus on, but I think this is how most fortunes are made, by focusing on the real economy. That's what I've found in my experience.
So you don't invest in commercial real estate. What part, sorry, office space, I should say, in the commercial real estate area? What do you concentrate on? I mean, where have you, and what do you feel bullish about there? If it's office space is hurt, we have Christopher asking about Digital Realty Trust. I don't know if you're familiar with that, but it looks like they do data centers. So what do you see working in commercial real estate?
Yeah, I mean, so commercial real estate or real estate is a levered play on GDP, and the asset classes that have been growing have been residential, especially in the Sun Belt, and we own 20,000 residential units in the Sun Belt. Industrial, and industrial is basically both of those plays, and then we don't own data centers, but if you look at all three of those plays, what's underneath of those drivers, it's technology. Industrial has been going gangbusters because of e-commerce, and the growth in the Sun Belt has been amplified by work from home and Digital Realty Trust, or data centers, obviously a technology play. So that's why you look at the big trends. The big things matter more than the small things, if you're operating at scale. And so when I look at data centers, I mean, the amount of compute that we're going to need to basically build the sort of next generation AI applications it's going to be vast. I mean, basically, electricity will become like the scarce resource, and playing that trend, whether you're doing it by investing directly in the tech or into the real estate underneath of it or some other part of it, I think it's the exception. As I'm saying, there's going to be a recession, but I think AI is a generational change.
So when Sam, our guest on Monday, brought up, and it was the first clip first person we played in the highlight clip we ran, was talking about the infrastructure spending that's already been committed and is starting to, with the same thing, a lag, but make its way into the economy. And his feeling was that was underappreciated. Does that offset some of the other issues coming from higher rates and the hit to the economy that you think hasn't been felt yet? Can those things offset each other?
Yes and no. So yeah, we see that also. We own industrial, and some of our super large properties that have 500,000 square feet. We've saw TSMC and ASML and those type of these critical companies come to us to lease the buildings because they're here. All of their vendors are here, and they're basically driving the Phoenix economy. I think the Phoenix economy, which is typically a boom bust economy, has this singular $80 billion investment from Intel and TSMC and ASML and other companies that are going to transform that basin into basically our silicon manufacturing center of America. So the reason why I say yes and no is that there's going to be winners and losers in this recession, and I think that this sort of onshoring or changing supply chains is definitely going to have benefits to workers, benefits to certain sectors, benefits certain regions are going to do well, and then there's going to be parts of the economy that just get wrecked. And there's no question that's going to happen, because it's just, you can't survive on 8-10% interest rates and an inverted yield curve in perpetuity. I mean, most of the commercial real estate, one of the things why you've seen delays is they've been able, you can buy derivatives or interest rate swaps or interest rate caps that can shield you from the changes in interest rates. And that's great, but they have a duration. And so you see there's huge companies, tens of billions of dollars size companies that have interest rate caps that are going to expire in the next 24 months. And when that happens, or even sooner, when that happens, they're going to have immediate losses, just giant losses. And so and those companies will suffer. At the same time, there'll be AI, and so it's not going to be like a singular event across all of the country and all of the sectors of the economy.
Yeah, that's interesting. We've had other people also bring up the suggestion. It's almost like a rolling recession, you know? So, two questions related to that, because that to me sounds less worse than a, the kind of, cataclysmic Great Recession, near depression that wipes out everything in the economy that we kind of went through in the Great Financial Crisis. So, two things: if we are going to get though pain to come, and it sounds like you're saying there's a lot of complacency about that right now. We're not taking into effect that lag. Is the central bank able to be more reactive now post the Great Financial Crisis, as opposed to looking to the 60s, 70s, 80s where we had these lags? They have more tools now, right? Can they inject liquidity in and respond in a way that means that we're not going to see the kind of economic collateral damage come? Can they be more strategic?
I mean, yes, but most of the reason we came out of the 2020 pandemic downturn so rapidly was because of the fiscal stimulus, because of the federal government dumped trillions of dollars into the economy, and they put some of it through the Fed by backstopping loans, PPP, and things like that. Monetary stimulus, policy is much more indirect, and as you saw it in 2010, 2020, we had zero interest rates. They had $7, $8 trillion of quantitative easing, and it really didn't make its way into the real economy. And mostly when it made its way into financial assets. And so it's not a great policy if you're trying to, in the short term, deal with unemployment. But it's here. There's a slide. If you go look at slide, remember this, slide 13. What happens in every downturn is before you go into the downturn, like things are great. Like 2007, unemployment's 4.7%. 2000, unemployment's 3.9%. I mean, this is not new. I mean, GDP is growing. Like before the downturn, things look great. And you can go find articles that will say, this is the longest boom in history. Everything's going so well. And then when it hits, it reverses so rapidly. And so the average increase in unemployment is 3.3%. And so that would mean we'd go from 3.7% unemployment to 7%. And it happens on average in 15 months. So like in a year, we go from low unemployment to high unemployment. That's typical of a downturn. And so like the essence of the argument now has to be, this time is different, right? This time is different. And that's a terrible argument.
Yeah, beware of that argument. I think we at least have learned that, although it never is exactly the same either. And this is where we get caught in that, in the trouble in terms of timing it and trying to see around the corner. I want to pull up and sort of end with one more of your slides, and that's your forecast for 2024. So it sounds like you think that there's pretty big trouble ahead for the stock market.
I mean,
this scared me. This bottom line, we're going to throw it up. I was like, oh no, when I glanced at them right before I came on air. I mean, that's, so that's a pretty big decline.
Yeah. All this is, right, is you take the last 9 recessions and you average the lag and the downturn. It's just an average of the historical changes, right? So it doesn't mean it's going to be this bad. All it is that, because in 2008 it was worse, right? So it doesn't seem like it should be as bad as 2008, but the average lag is 10 months from peak interest rates. So the Fed is saying peak interest rates is December 2023. So that means you wouldn't see a recession until end of 2024, and then 2025 would be a recessionary year, which is the first year of the presidential cycle, and that's typical. First year of presidential cycle is typically a downturn, and the average loss is 43%.
Mm.
So maybe it's not 43%, maybe it's 25%. I mean, you're just taking averages, and averages can be deceiving, but that's so significant that when I look in the short term, I just say, well, don't let the short term distract us from making long term good, more prudent, wiser decisions.
Yeah, and no one who's counting on that for retirement wants to see a drawdown that's anywhere near any of the numbers you just mentioned. So, it is really serious. Couple of questions. By the way, we're talking about infrastructure. Hopefully none of you can hear it, but there are so many diggers outside my house right now that it's literally shaking my house. I'm sitting here vibrating from it. So, I mean, it is like shovel ready in action. We've talked about it earlier, just in case I hit a cable and I disappear again, though. I'm warning everybody. 2 questions related specifically to your fund, and I'll stretch it a minute to get this in. Paul asking, what adjustments does your company need to make, or are you making, to prepare for the recession?
Yeah, I mean, I've been I've been pretty consistent for a while. So we've been I described ourselves as like the ants who store away for the winter while the grasshoppers out, singing and playing. So that this has been like, and this is my view. I could be wrong. We'll find out. But this is like, I gave up a lot of the upside to try to build up liquidity, have more cash, own things that I think are a little more stable. The investment, if you think about the investment, if I'm right, then you want to be in credit, because if there's a recession, you'll be more protected because it's basically debt, not equity. And that means they'll appreciate, because if interest rates come down, that credit will be more valuable. So the other thing we do, we're in a lot of credit. We have a credit fund. And so I think credit and cash and maybe AI, depending on your risk profile, those are the things that make sense to me, considering the forecast that I have.
And then Christopher asking, if real estate gets really distressed, how does Fundrise benefit? Does the company have a way to bring in money quickly to play the Sam Vulture game?
Yeah, that's the exciting thing, because if you go back to 1981, 82, where you had high interest rates and inflation, and they finally got it under control, because I think we're going to get it under control. It's just a question of what's the consequence of that. Real estate came tearing out of that. I mean, it's just booming. So that there's like a really exciting opportunity to buy. Not yet. I think my view would be late 2024, 2025, and that buy is like, again, like it's a generational buy, or maybe once every 15 years you can really buy. So that's, but it's not yet. So I would be in cash. We're in cash, credit, and AI in the meantime.
Yeah. Great stuff. Always really good to make that distinction and get a chance to talk about what people are seeing in the real economy versus the financial economy. It is the distinction we've talked about before, but we can end up focusing just because of, the charts and the headlines, and especially given what's been going on in the market and in stocks like Nvidia. And, it's really important to plug back in and get feedback on the real economy. So we really appreciate that, Ben. Great to have you on.
Yeah, thanks for having me.
Thanks so much. Have a great weekend. Have a great weekend to all of you. I have to tell you all, programming note, that we are Raoul's doing an AMA this Monday, 3 p.m. I want to make sure I get that right. This Monday, 3 p.m. It's a Plus member Ask Me Anything, and it's going to be on the business cycle courses. There are 2 of them have released on the Plus levels. So check them out. And then Raoul is going to do an AMA based on that. I was there when they did that. It was amazing. So make sure you tune in for that. And then, of course, we'll have the daily briefing after that. So hope to see you at both. Have a great weekend, everyone. Take care and good luck out there.